Welcome to another installment of Westmount Wealth's quarterly commentary. My name is Lorenzo Pederzani. I'm one of the portfolio managers on the team.
And I'm Matthew Evans, the other co-portfolio manager with Westmount.
We're going to change the format a little bit today. We're going to tighten things up to bring you everything you need to know in less time. So let's get right into it. Matt, how did the markets react to the possibility of fewer rate cuts than anticipated in the last few months?
Well, in the first quarter, we actually had quite strong returns from all equity markets. So whether you're looking at Canada finishing north of 6 or towards the more growth-oriented U.S. market with the NASDAQ finishing up just shy of 11, the equity markets, as a surprise to us, were able to absorb the new information and it showed in the return set. So we've had inflation slowly coming back into that target range that central banks are feeling comfortable in, and that's kind of that 1 to 3. So you can see here on the chart that we're just hitting that level in the U.S.
And in Canada, it's a pretty similar situation where we see the Bank of Canada trying to target generally a 1 to 3% inflation range. Inflation as of the last quarter has now just dipped into that 2.8% range. But it doesn't really tell the whole story. And that's really what we're hearing on the news. And certainly it's kind of big political discussion is the fact that housing inflation has still remained very sticky. That's a problem because, looking at mortgage debt in Canada and general household indebtedness, we can see when we look at this graph that even though historically Canadian and U.S. household indebtedness generally moved in tandem, since the great financial crisis, now the average Canadian is about 2 times as indebted as the average American. So the Bank of Canada might have more pressure in terms of dropping rates a little bit sooner than the US as a result.
I think the most important thing to take away though is if we look at where we were in January, where we were expecting anywhere from 6 to 7 cuts as early as March, that expectation has changed dramatically. And now we're sitting at that kind of 2 to 3 cuts, and it's been pushed all the way out to potentially June. And really, that's what we're talking about here, was that equity market's ability to absorb that new information and not pull back at the extent that we thought it could. So in an environment with higher rates for longer, how does that kind of inform the way that we, Westmount, set our asset allocation policy?
So let's break it down by asset class. On the equity side of things, despite the big run up in the equity markets that we've seen, we have maintained our target allocation. However, we have made one tactical shift. And that is taking some of our U.S. equity weight and taking it from a market cap based weight to an equal weight perspective. The reason for that is that currently we're seeing the big 7 tech names that we're all aware of hold a disproportionately large share of the value of a market cap index. And to reduce some of the sensitivity and the volatility to those names, we've taken some of that U.S. exposure and brought it back to an equal weight instead of a market cap weight. On the bond side of things, we saw a very significant rally in bonds in 2023 with the anticipation of rate cuts becoming a reality. Obviously, the first 3 months of the year saw really an adjustment expectation over how soon we'd see rate cuts and also how many rate cuts we'd see this year. And the bond markets have been digesting that. So we've seen a little bit of a pullback in the bond markets as well as a result.
And I think with that kind of uncertainty in the markets, that speaks to why we hold our target weight in alternative assets. And those assets are really meant to be held within a diversified portfolio of stocks, bonds, and alternatives, and used to help mute some of the choppiness that we might see throughout the rest of the year. I mean, we've got U.S. elections coming up, as well as geopolitical risks that are starting to bubble. So we like the fact that we have these lag valuation assets in our private markets to help mute the uncertainty that we might see moving forward. So specifically, when we're looking at what do we like in alternative assets, private credit stands out. And in an environment where we've got higher rates, that just means that us as the investor are going to be receiving a higher rate of return because base rates in which we are lending off of have moved up and spreads still remain healthy. So it's quite a nice way to position the portfolio. In addition to that, we like infrastructure. Infrastructure and natural resources provide a nice natural hedge in the case that we do not just get sticky inflation, but we get a resurgence in inflation due to geopolitical events. So it's a nice natural hedge against what we're doing in the fixed income and equity side of the portfolio.
We do these quarterly commentaries to kind of share our thoughts and educate clients and other colleagues, but we'd love to hear from you. If you have any comments or opinions, please feel free to share them with us, and we'll try to include them in our next quarterly commentary. Thanks for joining us. We'll see you in 3 months.